Hi and welcome to another Fireside Chat hosted by Credo Wealth. For those of you that don't know us, Credo is an independent wealth management business founded in 1998 with assets under advisory of over £4 billion and over 7,000 clients across the UK, South Africa and the rest of the world. I'm Ainsley To, head of multi-asset based here in London, and it really gives me great pleasure to introduce our guest today. Campbell Harvey is a professor of finance at University and a research associate of the National Bureau of Economic Research. He served as president of the American Finance Association in 2016 and as editor of the Journal of Finance from 2006 to 2012. Cam has also been a visiting scholar at the Board of Governors of the Federal Reserve System, and he's published over 150 scholarly articles on topics spanning investment finance, emerging markets, corporate finance, and many others. He was recently named 2020 Quant of the Year by the Journal of Portfolio Management and #1 global top voice in 2020 for finance and the economy by LinkedIn. And over the past 7 years, Professor Harvey has taught innovation and crypto ventures, which focuses on decentralized finance and blockchain technology. And his upcoming book, DeFi and the Future of Finance, will be published by Wiley later this year. Cam, welcome.
Great to be on.
Perfect. And where are you speaking to us from today?
I'm in my office at Duke University in North Carolina.
Perfect. And how things been over there in terms of the lockdown, etc.?
Actually, it was pretty interesting because Duke was disrupted, but not as much as other universities, in that we had a very active testing program all along. So we held in-person classes, so it wasn't all by Zoom or some other technology. And we are, as of August, fully operational in person with all of our students vaccinated.
Perfect. So given the breadth of research and your expertise, there are so many things that we could talk about today, which would be of great value to our listeners, from factor investing, risk management to asset pricing. But given the current interest and your upcoming book, I thought it was very timely to focus our conversation on one area that you've been involved in for some time, which is decentralized finance and cryptocurrencies. So just for members of the audience who are less familiar, you were editor of the Journal of Finance, which is the top academic journal in the field. And rightly or wrongly, that is not a background people typically associate with someone who's an early adopter of cryptocurrency. So how did someone who held one of the most prestigious positions in traditional finance come to be interested in this space so early on?
So when you publish in a top academic journal, you have to be very creative, because you have to look for big ideas that potentially change the way that we think about the world. And when you're editor, you're actually looking for those big ideas. You want to publish the papers that will win Nobel Prizes. So being an academic at a top university, the most important quality is creativity. And the way that I got interested in crypto is related directly to my time as editor of the Journal of Finance. So for 6 years, I was editor. It's a full-time job because we get maybe 1,500 manuscripts a year. And these are not easy reads. So it was just, I couldn't teach. It was a full-time job. So when it was over, I decided to go back to teaching my traditional course, which was international finance. And I decided not to use the same notes that I used 7 years earlier, but to basically redo the course. Like, I threw everything out. And probably most of you remember being taught by the professor that would have slides that were 10 or 15 years old. I didn't want to be that type of professor. I wanted to do new things. So I decided to rethink my course. And when I got to the section on foreign currency, I started thinking, well, if I want to do something new, what about adding a module on Bitcoin, a cryptocurrency? So I didn't know much about it. I I don't have a computer science background, though I have published in the top computer science journal, and I definitely am a programmer. But I decided, okay, well, that's going to be one of my lectures. So I started doing the research to do this lecture. And the more I researched it, the more I realized that this was just a very elegant idea that was under the radar screen, that had great potential. And I worked on a draft, our presentation. I reached out to the Duke Computer Science Department for help, but there wasn't anybody working in this space. Then I reached out to somebody at the rival university, the University of North Carolina, and the connection was set up by somebody at Duke. And this person was incredibly knowledgeable and was very, very helpful in me putting this presentation together and answering questions. But I was really nervous because I'm going in front of my students and for a 2-hour lecture. Usually we're talking about stuff that I've got multiple publications on, that I can answer their difficult questions. But this lecture was going to be different because I'm at a great disadvantage. So this person that I've been emailing with, I basically said, hey, can I come over to UNC and practice the lecture and you can critique it? He says, no, I'll come over to Duke. And I said, oh, well, that's very generous. I couldn't believe they'd be so generous. I was trying to make it easy. So then basically they said, what is the closest bus stop to your university? And then I started thinking, different than big cities, almost everybody drives around my area, but this person's taking the bus. I looked up the faculty at UNC, noticed he wasn't a faculty member. I thought he was a faculty member. So I get and pick him up at the bus stop. This is a student. So, and the student is in his 3rd year, so not even a senior. And he was just incredibly helpful to me. And we put together this presentation. And I said, well, what's the story in terms of you getting a job? And he said, well, I've done enough courses after 3 years to graduate. Indeed, most of the courses were graduate courses. And I said, well, you're applying for a job? And he said, no, but I haven't applied for any jobs, but I've got lots of offers. And I said, what do you mean? So, well, I've got about 10 to 12 offers from all the top tech companies. And this person was a Bitcoin developer. So I do my lecture incredibly nervous. And usually at Duke and most universities, when time is up, all the students just get up and leave. So I've seen that, I've lived through that. I finished the lecture and it was weird because nobody moved. They were just sitting there. And I'm thinking, wow, I guess I really bombed this lecture. And then a few students came up to me after the lecture, and more students came up to me and said, this should not just be a lecture, it should be a course. This is the most important lecture that I've had during my education. So not just at Duke, that it was transformational for my students, and to get a glimpse of the future like that. So then I built this into a full course called Innovation in Crypto Ventures. It is very difficult to teach this material because it depreciates very quickly. So my course from 7 years ago doesn't resemble the course of today. Indeed, the course of last year doesn't resemble the course of 2021. And as you mentioned, my course is heavily oriented towards decentralized finance.
No, and when you hear Paris Hilton, who's notably an advocate of Bitcoin, say that she's an early adopter in a couple of years from a couple of years ago. Well, yeah, 7 years is really quite a long time in the space, and as you say, it moves so quickly, and it's very difficult to keep up. But before diving into some of the innovations within DeFi and some of the more contemporary things, I thought it'd be we'd be doing our audience an injustice if we didn't spend a little bit of time unpacking what blockchain is, in particular, some of the bits and pieces on hashing and the consensus algorithms. And I do appreciate you mentioned, for some of these pieces alone, your course spends 2.5 hours, so it's going to be quite difficult in a short period of time. But maybe you can explain why it's such a revolutionary technology, blockchain, and how it fits together.
Sure. So blockchain is a technology that's been around since 1991. So well before the famous Bitcoin white paper in 2008. And let me try to explain what it is. So blockchain, think of it as a database. Think of it as like an Excel spreadsheet. And you got a spreadsheet, and it's going to be shared. So it's not just one copy. So that's the idea of decentralization or distributed ledger. So it exists on many different computers. And the idea is that you can't edit. So if you have an Excel spreadsheet, it's got 200 rows, you can always go and edit row 100. But with blockchain technology, you can only add to the ledger. So you can add a row for like 201. So you can actually do that. So the way that this is enforced is ingenious, and it's the reason it's called blockchain. So instead of just having one Excel spreadsheet, think of it as multiple subsheets. And within a subsheet, there are transactions, and it's all plain text. So anybody can see it. It's wide open. But at the end of the subsheet, there is a digital fingerprint that is unique to all of the data in the sheet. And that fingerprint is called a cryptographic hash. So what's interesting is the next sheet, or the next block, the first line of that next sheet contains the fingerprint of the previous block. And that's the chain. So think of it as the last line of the previous block is repeated on the first line of the next block. So the interesting thing here is that you've got all these blocks that are chained together, that if somebody in the network goes and edits one of the blocks, then the fingerprint on the last line will change. And it won't match the fingerprint on the first line of the next block. The network sees this and basically replaces the corrupted block with the block that has the fingerprint that actually matches. So effectively, what we're doing here is creating this transparent database that has got no single point of failure. It's redundant in that the same thing is repeated on every single node in the network. But it is a record that probabilistically cannot be altered. It's set in stone. It is like the truth. Once it's there forever. I've described kind of a simple version of this. It is a little more complicated in that an attacker could potentially go and edit that one block and then just keep on editing all of the blocks forward. So we want to actually prevent that. So what we do is to make it computationally extremely difficult to go back and rewrite history. And the way that we do that is in the block. Remember I said you've got transactions, and then you take a fingerprint of the block, and it delivers a cryptographic hash, which is just a number. And what the miners actually do, they do two things. The first thing is they gather pending transactions and make sure that all of the transactions are valid. And by that, it means if you're spending some money, you need to make sure that the account actually has the money to spend. So they validate the transactions, and then they do this cryptographic hash. But before they do that, they add a number called a nonce. And it's just a counter. So you add a 0, a 1, a 2, a 3, a 4. But each time you add this number, you do the cryptographic hash. And what the miners are looking for is a very rare hash that's got a lot of leading zeros. Okay, so it's computationally intensive to do that. And an analogy would be you've got 13 decks of cards. Each deck has 52 cards. And you've got a machine that shuffles those 13 decks. And then the machine also allows you to draw the first 13 cards. And what you're looking for are 13 in a row aces of spades. Okay, so that's going to be a lot of shuffling to get that. And cycling through these numbers, the so-called nonce, which means number only once, that takes a lot of computing power. So it makes it technologically infeasible to actually go back, edit a block, and maybe pay some cryptocurrency to yourself, and then change all of the blocks that happen after that. The amount of computing power is enormous indeed. This is called a proof of work mechanism. So the work is cycling through all of those numbers, trying to find that very, very rare hash that has got a lot of leading zeros. So this proof of work is used for Bitcoin. It's used for Ethereum. And it is energy intensive and, frankly, environmentally reckless. So it's kind of interesting that one of the greatest strengths of Bitcoin and Ethereum is that it doesn't make any sense to try to hack. It's the amount of computing power necessary would be so expensive to try to gain control, to gain 51%. It's just not worth it. And then even if you gain the 51%, what are you going to do? So if somebody gains 51%, then the value of the crypto will plummet. So it's not, it doesn't make any sense to actually do this. But it's interesting. Again, this is a great strength of the security, and this is an unprecedented amount of computing power that backs these ledgers to make them secure. So you don't need to worry about a hack of a blockchain for the leading blockchains. But it's also a disadvantage in that the environmental cost is very large, and some people have estimated that the environmental cost for Bitcoin is the equivalent electricity of the country of Argentina. So that's a big disadvantage. But I will say that, in my opinion, this is a temporary issue. So, for example, Ethereum, which is the main blockchain platform for decentralized finance. So my course is almost 100% Ethereum. I talk about Bitcoin just a little bit. So Ethereum will morph to a different consensus mechanism called proof of stake. And this is vastly more energy efficient and environmentally friendly. Bitcoin, I don't think, will ever change from its proof of work. So it will always be intensive in terms of energy input, but things will change. We're already seeing this with Chinese miners being clamped down upon, and a lot of the miners that are drawing fossil fuel based energy will just be essentially regulated away. And I'm very positive on countries that have what I call locked energy. So Iceland is a good example of that, where they've got essentially unlimited clean energy from geothermal and hydroelectric, but they can't export it because it's technologically infeasible to lay a cable to Northern Europe, a transmission cable. So they've got all this locked energy. So why not move the mining operations to Iceland, where the energy is not just clean, it's cheap. And indeed, we're seeing that happen already. And people have estimated that 8% of the Bitcoin mining is happening in Iceland. And I see that as that country becoming much more dominant in the future. And therefore, you solve the environmental issue for Bitcoin. And even though Bitcoin will not change from the proof of work, Bitcoin survives and thrives in the future.
And you mentioned Ethereum, and one of the key differences there is the enabling of smart contracts. Other than some ideological differences with maybe the Bitcoin community and hence the different consensus algorithms, maybe you can talk about, if we shift gears to some of the innovations that have happened within the DeFi space. Smart contracts is one of those, and the things that it enables.
Yeah, sure. So Bitcoin was the first cryptocurrency, and it was originally going to be a transaction mechanism. And famously, the first transaction was buying a couple of pizzas for 10,000 Bitcoin. So that was the vision of Satoshi Nakamoto. But it really is not a very good transaction mechanism, at least for small transactions. So there's a limited number of transactions that can happen per second. Let's say 10 compared to Visa that can do 75,000. It's also not immediate. So the blocks are added every 10 minutes. And you usually need to wait a couple of blocks. So it could be quite a while to get a transaction actually into the Bitcoin blockchain. So for small transactions, it doesn't make a lot of sense. And Bitcoin is more of a store of value today, or a mechanism for large scale transactions. Indeed, during my course this year, there was a Bitcoin transaction for $5.4 billion in a single transaction, and the fee was $17. So really, really cheap. So for a large transaction, but if you're doing a small transaction, a fee of $17, that's just infeasible. So again, Bitcoin was the first. It's more of a store of value, even though it's very volatile store of value. The second iteration was the Ethereum blockchain, and it's different than the Bitcoin blockchain in that, as you mentioned, we can have contract accounts. So in Bitcoin, you've got what we call externally owned accounts that you can transfer Bitcoin from one person to another person or a group of people, and it's a transactional sort of mechanism. You can do all of that on the Ethereum blockchain, but you've also got the possibility of deploying what's called a smart contract. And smart contracts also been around for quite a while, since 1997. But the smart contract essentially is a small computing program, and it can have its own address. So this is, it's called a contract address. So this is immediately different than the Bitcoin architecture. And these are simple computing programs. they reside they're part of the Ethereum blockchain, which resides on every node. So it's the same as Bitcoin. Every node has got a copy of the database, which is the Ethereum blockchain, and of course the program that drives it. But it's more than just a simple database. You can actually execute a program, and it might be very simple, like a call option. So if the price is above X, pay the difference between the price and X, or it could be much more complicated. So it allows for computation. The Bitcoin blockchain doesn't currently allow for computation. So some people refer to Ethereum as a decentralized computing platform, or the Ethereum virtual machine. So it actually can do stuff beyond transactions. And that opens the door to what I believe is the most significant innovation, and that is decentralized finance, which allows for interactions, financial interactions. And I'm not just talking about exchanging funds. I'm talking about lending, savings, exchange, insurance. It is a very large number of possibilities that are decentralized. So you don't rely upon any broker or anything like that. This is basically just a program that resides in the Ethereum blockchain.
Because I guess the transparency and the simplicity of having everything in code, it doesn't come with some of the issues we have with natural language in traditional legal contracts, which can be ambiguous from time to time. But in terms of how the smart contracts work, maybe you can talk a little bit about gas and the importance of that in that ecosystem.
Yeah. So one of the issues here is that somebody could deploy a smart contract or a small computing program that just basically runs in what we call infinite loop. And it basically means that every single node on the Ethereum blockchain has got this program running in the background forever. And it doesn't really make a lot of sense. So in computer science, it's called the halting problem. You want to prevent something like that happening. So Ethereum invented this idea of gas. And essentially, the idea is analogous to a car. So if you want to drive somewhere, then you need to fill the tank with a certain amount of gas to get from A to B. And if you do have a rogue situation, and that would be, let's say, a self-driving car that you lose control of, and it just keeps on going, well, it's not going to go forever. It's going to go until the tank is empty in terms of the gas. So it solves this problem of kind of having all of these programs running that are bad programs that are taking all of the time and processing. So gas is a way to deal with that, and the gas that you need depends upon the complexity of the transaction. So if this is a simple transaction where I send 1 Ether to you, then the gas fee is very cheap. But if it's a complex transaction where potentially dozens of transfers are happening, then the amount of gas that's necessary is larger. The amount of gas just depends upon the computational the complexity. It's very straightforward to work that out. The price of gas depends upon market conditions. So if there's a lot of demand, then the price goes up. It's just an auction. So it's a very elegant idea. There are issues. The gas fees, a couple of months ago were really, really high, which meant it was really difficult to transact in terms of small things on the Ethereum blockchain. The fees have come down, but they're still very high. And this really has to do with the Ethereum architecture. So remember I said that both Bitcoin and Ethereum use a proof of work sort of method. Ethereum has been working very hard over the past number of years to come up with a different approach that will allow for more transactions per second. So currently they top out at about 30. And again, that's way less than the 75,000 of Visa. So a number of mechanisms are being designed. Proof of stake is one of them. A mechanism to kind of split chains is another. There's layer 2 technologies we can talk about if you want, and kind of rolling up transactions into like a large transaction. All of these are on the table, and we will see within a year, and in my opinion, a vastly different experience for the user, where the transaction fees, the price of gas goes down very dramatically, and the number of transactions per second increase very dramatically. Indeed, there are competing chains to Ethereum that have already done some of this stuff. They're already using proof of stake. They're already able to do many more transactions per second. So it is a race because if Ethereum doesn't transform itself within the next year, then people will just move to these other chains, which have significant value right now. So it is important that, again, Bitcoin was originally for transactions, but given that it's just really awkward to deal with for small transactions, I think that most of the action will happen in an Ethereum-like blockchain.
And yeah, in terms of proof of work versus proof of stake, and maybe some of the layer 2 solutions, maybe we can come back to those in a bit. I did want to talk about some decentralized exchanges. So for a lot of retail investors first getting involved in the space, they might buy some Bitcoin or Ether on Coinbase or Binance. But of course, these are centralized exchanges, and there's something very different to something like a Uniswap or SushiSwap, which is what they call a DEX, DEX. So maybe you can describe what a DEX is and how they differ from centralized exchanges, and also touch on the AMM and liquidity pools architecture.
Sure. So this is really important that people think that Coinbase and Binance are decentralized finance or DeFi, and that's actually not true. So I call them CDeFi, so CEDEFI. And what that means is they're in the business of centralized, decentralized finance. So effectively, they're just brokers. So they're no different than traditional brokers, other than what they deal with. They deal with cryptocurrencies. So obviously they've been in the news a lot. Coinbase, extremely successful company, and recently IPO'd. So they've done very, very well. But the competition to Binance and Coinbase are decentralized exchanges, so-called DEX. And a DEX is basically a computer program. And it's really interesting because the program doesn't care if you're a buyer or a seller. Like, that's way different than centralized finance. So centralized finance, there's a price for the buyer and there's a price for the seller, and the centralized institution is taking the spread. So these are basically computer programs, and it doesn't matter if you're a buyer or a seller. So you mentioned the automated market maker, and that is an example of a program. And essentially, somebody will seed a liquidity pool. And if we're talking about version 2 of Uniswap, you would put an equal value amount of each asset into the pool. And the idea with a constant function market maker is that there's something called an invariant, which is simply the product of the amount of supply of the two assets. And the program runs in a way that invariant always remains the same. And that delivers the price dynamics. It's incredibly simple. There's issues with this. And some of the issues actually have been solved with the recently released version 3 of Uniswap. And that went operational May 5th. So, and it's quite a substantial upgrade where if you're supplying liquidity into a pool, then you can actually specify the range of prices that's acceptable to you. So now the pool has got essentially multiple price curves. For the user, you don't even notice this. But for the people supplying the liquidity, you've got that range. It's almost like a limit order range. So again, in my opinion, the major threat to Coinbase and Binance and other centralized exchanges are the decentralized exchanges. It's a lot cheaper to transact there. It is also, because it's an algorithm, you can trade anytime. So this is not a 9-to-5 exchange. This is a 24/7 sort of situation. And that's really important for decentralized finance. So you need to be able to have transactions happening at any time. And it doesn't matter if it's a holiday or the evening. And these decentralized exchanges, they actually do the job. So this is, this is a really big idea. So, and essentially, what we've got currently with the centralized brokers is, in my opinion, a temporary situation. And it kind of made sense that we'd have centralized brokers in kind of the first wave of cryptocurrencies. Kind of made sense. But in the future, we're moving more towards decentralized. And indeed, you can basically do almost anything here that is a token. So the token need not be just Ethereum or one of its many ERC20s, but these ERC20s, which is a token based upon Ethereum, they could be backed by all sorts of things, including stocks. So all of the stock trading will migrate to tokenized trading on a DEX. Kind of makes sense. Indeed, I'm reminded of a talk I did in terms of one of the leading traditional equity exchanges in the world. And they invited me to give a talk. And it wasn't really that clear what I was going to talk about. It was more of a question and answer sort of session. But I arrived and the complete board of directors is there, plus all the senior management. And the question to me, the first question is, how long do we have? And I think that's really telling, because they see that the business model that they've had for the past 150 years is at risk. And what can they do to potentially change to either buy time or come up with a completely different business model? So DEX is something that just makes a lot of sense. I'll tell you, one additional story, and this is way back in 2001. And my partner and I came up with an idea that we thought was a good idea, and it had to do with trading foreign currency. So if you, let's say, need 100 million euros at the end of September, you go to your investment bank and they'll quote you a price for that. And then somebody else at the same bank might need to sell 100 million euros at the end of September, and the bank will quote another price. And as I said, the bank is making the spread. So our idea was to put those two customers together. And we could use the bank in terms of its credit function and pay a small fee, which would be trivial compared to the spread that they were making, but it would be a much superior customer experience for the two customers. Indeed, this idea networked because many of the customers did business with more than one bank. So essentially, you put everybody together in a peer-to-peer sort of system that is kind of run by the banks. And it was really interesting, because think about doing a pitch to that bank's board of directors saying, hey, we want you to spend a lot of money developing this system. We've just got the idea. And, oh, by the way, this will cannibalize one of your most profitable businesses. That's a tough sell, a really tough sell. But even at the time, these leading banks realized that it was a matter of time for them, because this business model just didn't have legs. And I think that's just in general true in the world of decentralized finance, that you can see the disruptions coming, and it's very easy to see the future in this respect. Often it's really hard to forecast the future. In finance, it's really hard to forecast what's going to happen to the FTSE or the S&P 500. But in terms of this technology, it's pretty straightforward. And that's why I've invested so much time in this, because I believe this is the future of finance. Indeed, that's the title of my book. And I think it's incumbent upon me to give my students a vision of the future. That is going to help them make decisions. I want my students to be disruptors, not disruptees. And I think that this innovation is really important. And it's unfortunate that the media focus on the price of Bitcoin. That's the main thing. Oh, Bitcoin dropped. Or there's some new regulations in China about Bitcoin. Or Elon Musk is tweeting about Bitcoin or Dogecoin. And all of this is beside the point. These are volatile cryptos. Bitcoin's volatility is like 5 times the volatility of the S&P 500 or gold. They're going to go up and down. But the focus is on that, when the real focus should be on the innovations in decentralized finance. Those are striking. and essentially could rebuild in a way that is so different than anything we've seen in the past 150 years.
I mean, even from an investor's perspective, so going back to automated market makers and liquidity pools, that system is quite interesting because now you can play the role of liquidity provider, and as a market maker, as long as then it has its own risks, but being able to deposit into a liquidity pool and earn a fee for market making is sort of a new concept for investors.
Yeah, it's like democracy in finance. So anybody can do this, even with a small amount. Think about depositing your money in a bank account. What sort of interest do you get if you get anything? So with this system, you can actually buy it, and let's say you don't want to speculate on the value of Bitcoin. Well, you can buy a token that is backed by US dollars. So it's not volatile at all. It's only as volatile as the US dollar. You can deposit that to provide liquidity and earn a fee. So you actually earn some interest. Whereas you can't do that with our current banking system. So it's a very interesting that, and it makes economic sense. So why is it that the savings rates are really low at traditional banks and the borrowing rates are really high? Well, you're paying for the brick and mortar and all of the layers of bureaucracy. You're paying for the insecurity, so the IT spend because of all the fraud and stuff like that. All of this you're paying for, and that accounts for the large difference between the savings and lending rates. So suppose you take all of that inefficiency out. Well, what happens? Well, the savings rate goes up and the lending rate goes down. Okay, and this is really important. The other thing is that you walk into the bank and you're a small business person and you're looking for a loan. It might not be a large loan, but it's really important. You're excited. You've got a project. You've done the analysis. It's 20% a year return on investment, which is great. You go into the bank and the bank says, well, it's just not worth it for us to do all the paperwork and to get this loan organized, but we'll lend you the money. Here's a credit card, and you can borrow on your credit card the amount that you're asking for. So that credit card rate is often 20% or greater. So you look at the project, 20% you can make, but 20% you got to pay. And the project's never pursued. And this sort of friction is very damaging for all economies, because that 20% project, that is the type of investment that we need to make, because those types of investments lead to robust GDP growth. We are stuck in this real GDP range of 2%, or maybe if we're lucky, 3%. And with the innovations in decentralized finance, it offers the possibility of all of these smaller projects being financed. And when you put all these small projects together, you've got large investment. And it leads to the possibility that we can kind of break out of this 2 and 3%, which in my opinion is largely the result of the inefficiencies in our financial architecture today, and move to the sort of growth that we see in some emerging markets. So 5 to 7%. And this is very important for another reason that has nothing to do with crypto. And that is a way to pay down the debt that economies have racked up over the last 10 years. So the best way to pay down the debt is with robust growth. The worst way is to increase taxes or to just print more money, which is also like a tax. So I do think that this is important in terms of raising economic growth. And right now, our system is constraining the innovation, especially of the small and medium-sized entrepreneurs.
Mm. And we touch on some of the newer things you can do within DeFi as an investor. So liquidity pools, but also you mentioned lending, stable coins. So on something linked to a dollar whose price tracks the dollar quite closely, you can get multiples of the interest rate that you'd get depositing in a bank account. Maybe looking at some of the more traditional techniques within traditional finance, and how many of them we can apply within DeFi. So for a fundamental investor, for example, are there any are there any things to look at there in terms of how you can get a gauge for the fundamental value of a DeFi token?
Yeah, so it's a real challenge because it's really hard to define the fundamental value of a cryptocurrency. Let's take Bitcoin, for example. Bitcoin's got very high volatility. And I believe that part of the reason is that there's disagreement over what Bitcoin should be worth. So you've got one camp that thinks, well, it should be worth $400,000. And the way that they come up with that number is, number one, Bitcoin is the new gold. Number two, there's $9 trillion worth of gold that exists in the world. And then number three, divide that 9 trillion by the 21 million Bitcoin that will be mined, and you get approximately $400,000. That to me is logically flawed, because in step number one, where you say Bitcoin equals gold, that's you're assuming your result. So it doesn't make any sense, but nevertheless, very high profile people have used that logic. So you've got that one camp. You have another camp of people that believe that the value is zero, and strongly believe that it's zero, that it's just a bubble. So a bubble is a persistent deviation from fundamental value. So the issue is, what is the fundamental value? So you might argue that the US dollar today doesn't really have fundamental value. So it used to be backed by gold, but after 1971, that ended. But the US dollar's got other features. So it's legal tender. So you have to accept it for payment. You're taxed in dollars. And if you don't pay your tax, you can go to jail. So there's other kind of levels of intangible value that give the dollar the value that it's got today. So for the cryptocurrency, there's nothing like that. So we can't do the sort of fundamental valuation. So if we're looking at the US dollar versus the pound, well, we can look at the US economy. We can look at the money supply. We can look at interest rates, and then do the same thing in the UK. And we can come up with a range of value. And maybe you disagree with my range, but we both have ranges. Or if we're looking at a stock, we look at the price of IBM, for example. And we can forecast what the future cash flows look like, the future earnings. We got some idea of the risk. And I come up with a range. And maybe you come up with a different range. And maybe we overlap a fair bit. But we got a fairly narrow range based upon fundamental value. So for Bitcoin, there's no exercise like forecasting the future cash flows, because there's no future cash flows. So you come to this issue that, well, Bitcoin's got value because people believe that it's valuable, which is kind of circular. But I think it's very important to think of not just tangible value, but intangible value. And so much more of our economy today is based upon intangible value. So is this a technology that's potentially useful? And the answer is yes. So Ethereum, it's very interesting because the tokens on the Ethereum blockchain are now more valuable than Ethereum itself. So Ethereum is this distributed computing platform that actually allows for all of these innovations like decentralized exchange. So it's actually providing value in that respect. So, and a token that's linked to a DeFi protocol, it's actually providing value to the user. So it should have some value that's greater than zero. So I think that it's a mistake to say, oh, well, we can't forecast the cash flows like we can for a stock like IBM. So there's no fundamental value. Therefore, the value of the crypto is zero. It's just a serious mistake because it ignores intangible value. Nevertheless, given the severity of the disagreement, we will see volatility as we've seen historically. So I'm not sure if that will ever end, but there is a lot of volatility.
So maybe, instead of talking about equilibrium pricing, in absolute terms, in cryptocurrencies generally, and I thought it'd be useful sort of talking about something which, maybe a bit more technical relative to day-to-day retail traders would, but just simply because to the DeFi space is the Flashloan and some of the interesting things that have opportunities and risks there. Maybe you can describe what Flashloans are and how they're used.
Sure. And given the poor connection, I heard maybe a quarter of your question, so you might need to repeat it. But let me talk about an innovation in DeFi that is very, very interesting.
Just on Flashloans and just how they work.
Yeah. So Flashloans, what is a flash loan? So it is a loan that you can take out without any collateral. Okay, so that's interesting first, because almost all loans, you have to have collateral. A mortgage, you need to pledge your house. So this is a loan that you can take out with no collateral. And on top of that, it's got zero duration. So again, what does that mean? Like usually a loan, when you take it out, it's interesting, the longer the maturity, usually the rate is higher because there's a bigger chance of defaulting. So this is a loan that's got zero duration, and it's also got zero counterparty risk. And the way that it happens is the following. So it happens in an Ethereum transaction where the loan is taken out at the beginning, and then money is transferred to various different protocols. And then the loan is paid back at the end of the transaction. So basically, that's what I mean by zero duration. So when the transaction goes through, then the loan is taken, and then it's used, it's deployed, and then paid back all in one transaction. And it's interesting that if any part of the transaction fails, then you go back to the original stake before the loan was taken out. Okay, so this is way different than the usual thing. People say, well, this is kind of like an overnight loan. So no, it's not an overnight loan. It happens instantly. And again, it's very interesting that there's no counterparty risk. So think of this. This could be used. The two main uses would be to refinance an existing loan. So, for example, you could refinance your mortgage to try to get a lower rate. And in centralized finance, that's very costly to do. And indeed, I recently did this, and it was remarkable. With the same bank, I refinanced, and they demanded a title search, even though the bank actually had the title. So, and I had to pay the fee for that. So, and took weeks to actually do. So this refinancing would be instant. And that's one use of this flash loan. And another use is just arbitrage across different platforms. And essentially you borrow to buy something cheap. You buy it, then sell it on another platform at a higher price. You take the proceeds, pay back the loan, and then keep whatever's left over as a profit, an arbitrage profit. So this is like a really great idea. I feature one of these in my class. It's an amazing set of transactions. It involves 62 different steps. But right at the beginning, there's a flash loan for like $200 million. Okay, so you think about that. Remember we mentioned this idea of democracy in finance? So in centralized finance, the people that are able to take out a $200 million loan, who are they? So the big investment banks, the hedge funds, maybe some of the large mutual funds, that's it. But in this space, anybody could do that. Again, there's no collateral necessary for this. So it's effectively risk-free. And I want to give like one caution on this, and that is, yes, there's no counterparty risk. There is no collateral. There's no other types of risk in terms of duration of the loan because it's instant, but there's still risk. And that is what's known as the smart contract risk. So there could be a flaw in the contract. So, and the type of flaw that could cause problems. But again, let me emphasize, if there was a step where there's a failure, you go back to the original place. So there's always risk, but it just basically everybody faces that same risk. And it doesn't matter who you are, a billionaire or somebody with $100 worth of crypto that you want to deploy to one of these platforms.
Perfect. Yeah, and I'm conscious we're sort of coming to the end of our time together. It'd be great, as we mentioned, the space is it moves so quickly. How do you yourself like to how do you like to keep up within with all the innovations, and how do you choose what to focus on?
Yeah, so this is actually interesting because it speaks to the problems the regulators face. So this is a complex technology. It was hard for me to learn about this. And what I've learned is basically just scratching the surface. So there's a lot more to learn. So think of the regulator. This is a complex technology. they invest the time to understand, for example, Bitcoin. And maybe it's a significant amount of time to understand that. But as soon as you come to that understanding, there's a new technology that that demands more education. So it's really difficult for regulators to keep up. It's also difficult for academics like myself to keep up. This is, not a course that is easy to teach, because each year the content changes. You can't just use the same slides from previous years the next year. This year, 85% of the material in my course was new. Okay, so the way that I keep current is, well, there are many different aspects to it, but I guess I'm advisor to certain crypto ventures, and that's helpful. I see what's happening in the field. I'm a consultant for an investment fund that actually is pitched all the time in terms of crypto, and has an excellent track record of investing. There are certain outlets that I follow, daily emails about what's happening in the space, like The Block and Digital Asset Research are two very good ones. But there's also Cointelegraph, CoinDesk. There's many different things like that that are useful in terms of following what is actually going on. And even the traditional news outlets have high quality people covering crypto. So I think of the New York Times, I think of the Wall Street Journal. They've got high quality assets deployed to this space because they know that it is important. So this is a lot more difficult than just kind of opening the Wall Street Journal and you've got all the information that you need. It is very specialized, very, very technical. So the recent upgrade that's proposed for Bitcoin, Taproot, you need to know what the difference between an elliptic curve digital signature algorithm and a Shor signature is. So that's not simple, right? I teach ECDSA in my course, and it's a struggle for my students, but I think it's important because you use it all the time. You use it not just for crypto, but you use it when you interact on the internet. So it is really challenging, but the thing that keeps me energized is that I see the scaffolding of a shining new city. And this is nothing to do about renovations of existing financial infrastructure. This is a complete rebuild from the bottom up. And for an academic whose mission is to impact in a positive way the practice of business, this is just ideal. And on top of that, it's early. So we're not even 1% into the DeFi revolution. We're not there yet. And that is huge opportunity for an academic, but it's also an opportunity for people in business. You always want to get in early for an important innovation. And this is really, really early. So that keeps me energized. And I always want to learn more. And one thing I think I'm pretty good at is knowing what I don't know. And there's a lot I don't know in this space, and I want to know and convey that to my students.
Mm. Well, there's one thing I can say in terms of my experience. Having started from zero, I can recommend enough your Coursera on blockchain, and getting up to speed with that. And it's been a fantastic conversation. I don't know if there's anything you wanted to add, Cam, before we sign off.
Well, given you mentioned that Coursera, I'm working on another one, and this will be on decentralized finance, and it'll be a series of courses. So it'll be a whole module, and I hope to launch that simultaneous with my book, DeFi and the Future of Finance, which will be launched in the third week of August this year.
Fantastic. No, and we all look forward to reading DeFi and the Future of Finance with great interest. So, Cam, thank you again so much for your time. It's been wonderful, and our audience will really benefit from what we've covered. And I do want to thank you personally as well, because there are very few people in finance whose work has been a bigger influence on me during my career over the last decade. So we've covered a small segment of all the research you published, but it's been wonderful. So truly grateful for your time today.
Well, thank you. I enjoyed the conversation.
Perfect.